Hello ladies and gentlemen, welcome to today's webinar. The topic is technical indicators. First of all, before we continue with today's topic, I would kindly ask each and every one of you guys to excuse my voice today. It's still altered from the flu that I had for a couple of days. However, I've never been more inspired to help each and every one of you to achieve profits on the market. Now, the first thing we're going to start with is the usual reminder about the questions that you might want to ask. Now there is a chat. Please put them in, and all of your questions will be answered as soon as the second part of today's presentation starts. This is the question and answering session. Now, the first indicator that we will start today would be the moving average. Pretty much, I know that every one of you guys know what the moving average does, but how it does it, we will find out right now. Now in statistics, a moving average is calculation to analyze data points by creating a series of averages of different subsets of the full data set. Given a series of numbers and a fixed subset size, the first element of the moving average is obtained by taking the average of the initial fixed subset of the number series. Then the subset is modified by shifting forward. That is, excluding the first number of the series and including the next number following the original subset in the series, of course. This creates a new subset of numbers which is averaged. This process is repeated over the entire data series. A moving average is a set of numbers, each of which is the average of the corresponding subset of larger set of data points. A moving average may also use unequal weights for each data value in the subset to emphasize particular value in the subset. So now you see how widely you can use the moving average by itself to measure so many different things. A moving average is commonly used with time series data to smoothen out short-term fluctuations and highlight longer-term trends or cycles. That's what we mainly use it. The threshold between short-term and long-term depends on the application. That's something that we will be talking about later on when I start showing you on the chart. And the parameters of the moving average will be set accordingly, of course. We use moving averages in the technical analysis of financial data, like stock prices, currency prices, commodity prices, anything, or even trading volumes. It is also used in economics to examine gross domestic product, also employment or other macroeconomics time series. So you can see the variety of methods that, the variety of applications of the moving averages. Mathematically, a moving average is type of function, and so it can be viewed as an example of a low-pass filter used in signal processing. Let's simplify the whole picture that I've said so far, that it can be regarded as a smoothening the data for the time period selected. Let's see what the moving average looks like on the chart. It's very easy to find it. Go to the function button on the top of your toolbar. You will find trends. Usually the moving average is right at the top. If you have used it for the one of the last times, you will find it also on your history bar over here. And of course, preset would be the last moving average that you've used so far. Now the moving average type we are going to use right now is the 21 period. And why do we choose 21 period? It's a bit more smooth than the 20 period. It's a bit more accurate, especially on the 1 hour chart. That's what I've seen so far. The method will be exponential instead of the simple moving average. And the application, as we said, is to close. It's a very important fact that all of other instruments that we will be using so far, the application will be one and the same. So, we can of course choose the style of the moving average. Let's pick yellow. And as you can see, the moving average is smoothing out the data from the past. And of course, it can be used as a key entry point. Very important to remember. Let's just choose another color here. I think let's use the yellow color. Okay. As you can see, strong support and resistance levels, what you can use the 21 period moving average for. Once it's breached in areas such as this one, you can expect strong move in the applied direction. And as well, if you find it as a resistance, you can also expect strong move in the same direction, as well as when it's breached on a high volume, you should also mind the volume itself. It's a very important figure if you are going to trade on moving average crossovers or with just one moving average, which of course is quite a good idea. But to be honest with you, we've always seen people making mistakes relying on the one moving average. It's very important to remember which moving average to use, because a moving average with a period of 21 or even a period of 20 if you want wouldn't do it too much good. However, presetting the time frame for 1 hour chart would pretty much increase the percentage of certainty that you might have a profit in a certain position. So, applying an additional moving average, which is extremely important, but of course, using along with it an indicator called Bollinger Bands, will even give you a bracket of upper and lower level, or the so-called upper and lower band of the Bollingers, and this will give you entries and exits, and a confirmation by the moving average with the period aligned properly. As you can see, both Bollinger Bands we've been using so far. Now let's apply it on the chart first. I will, of course, highlight key points to remember during the explanation of what Bollinger Bands are, what is the technical indicator used for, and simply the period is one more time 14. Why is 14? You will find out later into the session. The deviation is a deviation of 3. So let's put it here. Deviation equals 3. Period equals 14. Application, of course, equals to close. Always. So, this is how Bollinger Bands look like. As you can see, the middle line, the white one, crossing over with the yellow, is, of course, the 14-period moving average, used as a middle point between the lower level of the Bollinger Band and to the upper level of the Bollinger Band. Let's talk a little bit more about the technical use of this indicator after we find out that the Bollinger Band is a technical analysis tool. It's invented by John Bollinger in the 1980s. Now, having evolved from the concept of trading bands, Bollinger Bands can be used to measure the highest or the lowest of the price relative to previous trades. Now, simply put, Bollinger Bands are a volatility indicator. It's a very important key point to remember here. Volatility indicator. The purpose of Bollinger Bands is to provide a relative definition of high and low. By definition, prices are high at the upper level of the Bollinger Bands and low at the lower band of the Bollinger Band, as we mentioned. This definition can aid in rigorous pattern recognition and of course is used in comparing price action to the action of indicators to arrive at systematic trading decisions. So, quite simply put, it's actually a trading strategy. So, the use of Bollinger Bands vary widely, of course, among traders. Some traders buy when the price touches the lower Bollinger Band and exit when the price touches the moving average in the center of the bands. Other traders buy when the price breaks above the upper Bollinger Bands or sell when the price falls below the lower Bollinger Band. How about that? They have never, nobody told you about the third, more proper way of trading Bollinger Bands, and we will see which one it is after, of course, analyzing why the deviation of 3. That's the first thing we need to talk about. Now, number 1, deviation of 3. Usually, by default, you're getting a deviation of 2. You can change it. I recommend use of deviation of 3 if, of course, your setup would be pretty much the same as this one, and if you're going to use the same strategy to find entries and exits. And of course, later into the session, additional indicators will support the price direction. So, definition number 1, that will say that a number 2 of deviation will give us 66.6% of certainty that the price will go either direction. Now, 66.6% that the price will stay within the Bollinger Bands. This one and this one here. Whether it's this one here or this one here. However, the one that we are using right now is a deviation of 3. And this is why it gives us 99.9% of certainty that the price will stay within those bands as we've showed so far. That's why you see in rare conditions when the price is extremely overbought or oversold, how to see those levels later on into the session. The price can peak above or can break below, in such a case like this one here. Let me arrow it if some of you guys don't see it. In such cases like these, you might be able to see the rest 0.1% of extreme market conditions, so-called EMC. So, going to number 2, hope you understood parameters number 1. Why is it so important to have a deviation of 3? Some of you guys might decide deviation of 2 gives you a bit more security. However, right now we're looking for the balance, which is profit according to our risk, risk-reward ratio, the so-called. Hope you understand. Number 2, the period of 14. Why are we using period of 14? Some moving averages. Some people use a moving average period of 10. Now, we want the moving average to have a period of 14 because it's much more faster, gives us a bit better options to enter. And according to the 1 hour chart, plus the additional indicators, all of them will be a period of 14, extremely important to align in one timeline. How that is possible, we will see later into the session. However, the application to close, that's the third relevant element right now. That was number 2. Number 3 here. The application definitely needs to be to close because all apply to close. And we need them to correspond in one timeline. this is extremely important. One timeline. Every time we get a signal, we need a confirmation from everything else. That is why all of this explained below here is extremely important for all of you guys. So if anybody wants to make a screenshot, now is the time, because I'm going to wipe it off in a couple of seconds, which actually gives me the time to remind you that the session is recorded. So even if you don't manage to catch the full session, or you just forgot some part of it, you can still review it after we upload it into our YouTube channel. We will talk a little bit more about how to find it and what you can use it for later into the session again. And I would pretty much highlight this question, which usually appears every time in our question and answering session. Thank you. Now, continuing further, you can see from the 14-period moving average, if of course, let's stand it alone, okay? Let's stand it alone here for a second. Let's take away the 21-period moving average. We will let only the Bollinger Bands plus the 14-period moving average. Why? It's extremely important to remember that the 14-period also acts as a support or resistance lines, but it, of course, filters those fake signals. By saying fake signals, that means, the bracket between that price, that's a sideways range. From here and here, you can see the upper level. Okay, let's say upper band and lower band here, and the price limitation between somewhere around here and somewhere around here. If I have to align it with time, probably is going to correspond over there. And that's pretty much a difference of about, what, 80 pips? It's not too much. So why should you, lose your cash on a long position here, a short position here? That's too much of a time wasting. So you can actually focus on a different instrument to find entries, such as this one, which is extremely beautiful. Now, after a slight consolidation, we have a downtrend for a short period of time. Even if we scroll back, we will see why this here is a good entry. Now, let's remember this as a point A and point B here as an entries. Now, how to pick our exits? There are a few different ideas. Some people use when, we know that this is the entry. Why? Because we have a consolidation of the Bollinger Bands. In that case, in time with this long, huge candlestick, we have a confirmation that the price will go higher. So we have a buy here, okay. The first exit should be somewhere around this point. This is exit number 1. Exit number 2 can be somewhere around this point here. This is exit number 2. Now, how do I pick that? Because, I've already knew that because I already traded it. How I found that out when I entered over here, this is my open, as I said already. We will scroll back in time and we will find that out. We will shift the chart in a few minutes. Right now, I just want to highlight a few other things. Why should we use the 14-period moving average along with the Bollinger Bands with 3 deviation? Now, every time the moving average is crossed by the price, you can long. Every time the price touches one of the levels, if in that case is the upper level, you can close your position. And of course, if it's in a trend, such as considering this one, point A, point B, to consider a trend, if we measure a retracement of 33% somewhere until here, which is exactly the same. Some of you, if you don't believe me, I've measured this hundreds of times already, so we can do it already, but it's going to save us a lot of time. Point A, point B, now we know this is in a downtrend. Our entry point is somewhere here. Our exit is over here. when the price breaches above and stays above. And when it stays above, that means you see this curving of the Bollinger Band. Oops, sorry. See this curving here, okay? The price is narrowing down here and then extremely up to the upside. Now this edge over here, strong pin, like a, you know, like a very sharp edge. This is your exit. This is where you can see a consolidation like this one. Instead, what we've seen here is not a continuation to the downside, you know, like this one, for example, with a short pin here and here. We actually saw a reversal to the upside. That's why your exit is somewhere here when you see the consolidation. That means the directional move is over, and now it will be followed by short sideways trend, otherwise said sideways movement, or a consolidation of the price between two levels. Short period of time or a long period of time, nobody can tell you until it is over. How to find that out? We will find in trend following. This is not the next, but the webinar after. This is extremely important because then we will be using Fibonacci retracement to measure the percentage of retraced price to suggest whether the trend is flat or too sharp to be sustained. So, moving back to the topic at hand, when you see the Bollinger Bands convening this way, you are always prompt that the move is over and you need to exit over here. And what you see on the chart, let's erase all of that. Let's shift a little bit the chart. What you see is this. Okay? I'm pretty sure when the price reaches here and you can see that the price is narrowing down, you know, it's making strong curve here. It's always telling you this is a point for me to exit. Why didn't you exit here? Because this is actually your actual entry. It's point A, as we mentioned, point B here. If that's another entry, if that's an entry here, if that's an entry that you made, that's definitely your exit, of course. Somewhere here or somewhere up here. You know, that's definitely your exit. If you have a expansion of the Bollinger Bands and for some reason you have traded in the right direction, always have to exit when the price is consolidating. So, meaning when you see flat Bollinger Bands, you know, that's where your exit is. And the 14-period moving average, as we mentioned, why is it so important to be used in this form, is because it's filtering out this move, which is extremely small, and you can't really say whether it's a directional move or whether the price change would be big enough for you to make a profit. Why? Let's see how big it is. Okay, the biggest one, let's consider the most absolute one that you might catch, which is extremely rare in such cases if you are following these kind of rules. This is 90 pips. However, if you have entered normally, here you have 50 pips up to here, additional 74 pips up to here, and even if you let the price flow, you have now 146 pips here. So that's pretty good in a directional move. So first one average of 50, the other one average of 70, and 150 on the final one. So you have about 300 pips of profit. Why not take this one instead of trying to make mistakes over here in this one, as well as between this one and this price here as well. So still, that's what the 14-period moving average does. Gives you a lot of fakes, but still it filters a lot combined with the Bollinger Bands. Still, we're not going to use only one or only two technical indicators. That's why we have confirmation by an additional moving average, which was the 21, which right now we are going to add additional to see what it does. was it 21? We already have it here. Now, the corresponding 14 period with the 21 period, what you need to look for is the deviation, or the so-called pull-off, distance between the moving averages. It's the same what you can use with the 200 period moving average, which is by far the most important moving average ever. All of the traders are looking only or mainly at the 200 period. That's why it's coming in red color, because red means attention. So right now what you see is all moving averages moving close to each other in this significant area here, which I wouldn't trade. Why say wouldn't? Because you can always trade if you wish, but if you want to be more of a conservative trader, you want to protect your investment, this is the area where I would stay away from this instrument. Pretty much there is no directional trade. Now where I would enter in these cases here, when I know that the price is always aiming to go to the 200, the most important one. So this is what you need to do for it, like this, something like that, all right? Okay, most important moving average, 200 period. Let's put it up for those which just came in. Where I would trade when I see the distance between the smallest moving averages, or the smallest moving average, which is the 14, starts getting bigger. This is pretty much where I would enter, and I would exit when I start see the moving average closing into the 200. So basically, this technique you can use as to use the candlesticks as a better entry on a shadow, or on a better entry candlestick if it's higher, so you can go short, or if it's lower, so you can go long. But those indicators are actually telling you how far the move will continue, so you can exit properly. Now, where I would exit, actually I would exit over here on this doji, or somewhere around those candlesticks, when I can see that the price is still moving in a sideways, when I can see the Bollinger Bands converging between. So when you see something like that, this is always telling you run away, because this area over here might continue to the downside, but in fact it goes up. That's why it's so important to remember the distance between moving averages is one of the main topics of using technical indicators such as moving averages, not to use it as a crossover. I mean, you can use it as a crossover to enter, but after you've entered, how exactly would you exit, or how would you pick the right way to enter when you don't use the proper levels of those moving averages, or how to prevent yourself from making a mistake? Exactly at this case, when you see the price moving close to the moving average, which is the 200, one more time, stay away. As you can see, the price is trying to breach it several times before it actually achieves it and then goes back to it. The best way to trade in these conditions is to find a trend and follow it. Of course, during that period of the trends, you can make multiple positions up or down only by following the distance between those moving averages, and always enter when the Bollinger Bands starts dividing from each other. Okay, when you see them dividing from each other, pick your right entry, and this would be according to the current trend and the distance between the 200 period moving average and the smallest one, which is the 14. The 21 can only give you middle entry points on multiple positions, if that's what you want, of course. Basically, you can somehow correspond it with the smallest period to exit from some of those positions. As I mentioned, still with the difference between the distance. Now we will move forward with an indicator that it's extremely important in the technical analysis. Something that I'm using every morning to analyze the chart, to make my predictions, and so on. One more time, I'm terribly sorry about my voice. It's still altered from the flu. We will be talking about the relative strength index, which is a technical momentum indicator, shortly RSI. It compares the magnitude of recent gains to recent losses in attempt to determine overbought and oversold conditions of a currency pair, commodity, any kind of asset. From now on, we're going to call it an instrument, as we always do. As you can see from the chart over here, if you imagine that you have, for example, another confirmation that you're making the right decision, such as the relative strength index, which you can find in oscillators. Of course, I've recently used it, so it's quite on the top, and you can see it over here as well, one of the recently used technical indicators. The parameters, as I mentioned, extremely important to correspond with the smallest parameter that we have on the chart, which is the 14. And again, the levels, you will find out in quite a bit of time after I actually explain what the technical indicator does. As you can see, there are multiple levels here. Why I have it, what I use it for, you will find out in a minute. The relative strength index ranges from 0 to 70, as you can see from the chart there. An instrument is deemed to be overbought once the relative strength index approaches the level of 70, meaning that it may be getting overvalued and is a good candidate for a pullback, let's say. Let's put it that way. Likewise, if the relative strength index approaches the level of 30 down here, it is an indicator that the price may be getting oversold. The instrument might be getting oversold and therefore likely to become undervalued. The RSI is one of the principal momentum indicators used when analyzing charts. That's why I mainly use it to confirm entries and exits. This article that you are included in right now in this webinar, we will focus more on the details in the relative strength index and how it's used to determine our entries and exits. The relative strength index can also be used to determine the true value of an oscillator, depending, of course, on the understanding of overbought and oversold positions. Now, there has always been a little confusion over the difference between relative strength, which measures two separate and different entities, by means of the ratio line, which is this one here. Of course, which indicates to the investor whether the issue's price action is created by those overbuying or overselling it. So there is a formula. Of course, I'm not going to trouble your mind with it. That's why the relative strength index does it for you. As you can see on the bottom of the chart, the relative strength index is on a scale from 0 to 100. It indicates that the overbought position is at 70 and the oversold is at 30. So why am I using additional levels? For an investor or a trader, we will choose to reset the indicator's parameters to 80 and 20. This helps to be sure when making the decision to buy or sell. So this is also preventing us from the pull trigger. You know, when you try to execute a position, you resolve, how to say, you know, overpunched by an adrenaline, so you're like not sure, but you're sure you want to enter because you want to make the money. Still, this indicator, choosing the right levels of 20 is an extreme oversold condition and level of 80 is an extreme overbought condition, will give you a better entries. As you can see, very often the price goes at those levels. Now imagine if you only had the custom ones, which are here and here. You will often make a mistake by buying the instrument too early or selling it too late. So let's take the timeline here and check. Okay, now on this candlestick here, okay, it's a very good indication that the price will continue to move down if only you're using the upper side of your chart without the relative strength index. Corresponding with the timeline, you will see that it's exactly closing at the level of 30, telling you it's pretty much going to bounce off of it. Okay, so I'm going to buy here, but what it does, it's going down with another 90 pips. Imagine if you're already in the margin call and you want to reverse some of those losses. You want to get some cash so we can get back into the game. This will definitely help you to make the right decision in important moves. So the level over here corresponds with these areas over here. So this is where you can actually buy it, but for a very, very short period of time. In most cases, you will close somewhere around the level of 30, when you know that the price, that you're in the right direction. Do not get greedy. Close the position as fast as possible for a very simple reason that many people are making mistakes is because the price is in a downtrend. So we don't buy when the price is in a downtrend. We always sell, and vice versa, of course. We'll talk more about trends in the future. But right now, I want to talk about all all of the positions that you can squeeze out of the market on such a time frame, and why I'm using the 1-hour chart, because it's extremely important, and because it gives us multiple entries on one day. You can make up to 5, 6, maybe even 10 positions if you're lucky. I'm talking about lucky if the market allows you to. But in this case here, you would definitely want to exit somewhere around the shadow of this, candlestick here. It gives you a few tens of pips entering here. That's about 40 pips. It's about $400 if you're trading with one lot. And of course, the next webinar, which is very important, this Friday, Forex risk management strategy, will show us how to equalize our positions. This is where I will show you what should be your size of your trade somewhere over here according to the take profit and stop loss levels, something that I will reserve for the next time. Now, moving forwards to analyzing the level of 50. Of course, we still have the level of 30 and level of 70. These levels are pretty good, and they are acting as a entry levels, especially when we have, should we say, low volatility. Okay, there are no news in the market that it can interfere, so the price can enter in oversold and overbought conditions in extreme way. Therefore, those levels are quite good to trade, as you can see. In the condition of this area over here that is quite tight in a range, so pretty much nobody would trade it. But if you are using the relative strength index, you have a very good indication to do it. Still, my entries would be crossover of the price of the 50 level. That's where I would enter either direction. In this case here, it's crossing over the 50, and then your exit is at the 70 here. So this is your entry, okay, and this is your close. If you have to timeline it, it's somewhere over here. Let's clean the charts first. Very important. Okay, your entry here or here, it's still the same. Your exit here. No, sorry, your entry is here. Disregard this one. Corresponding with the timeline, it's somewhere around these candlesticks over here. This is where you can enter. You can see the price is moving above the 14 period moving average, and it's getting to an extremum, which is at the upper level of the Bollinger Bands, which in time corresponds pretty much with the level of 30 over here. So you can see how you can timeline all of these events to get additional confirmation. And this is just one position. This is one position which is extremely certain, of course. Why shouldn't it be? You have pretty much about 70 to 80% certainty on this one. That's about 50 pips, one lot traded, $500 profit. There you go. Another one, if you have the proper levels, if you want to trade properly, there is your entry. You can see the price tried to breach this 50 level a few times, consolidating in a sideways range, and you're using the Bollinger Bands one more time to see that the price, the Bollinger Bands are not expanding anywhere instead of here. This is where you can see it corresponding in a timeline somewhere around those levels here. This is your entry, and your exit is one more time you can exit here. This is your first exit, your sure exit on the level of 30, because you never know if the price will enter into extreme oversold conditions, but you still leave. Let's say you're trading with 3 lots. This position number 1, you're terminating 2 lots. Position number 2, which is on extreme oversold conditions, you're terminating the rest 1 lot. This is the proper way of trading in a trade, in a directional move, in a proper trend, when of course I'm excluding the sideways trend. So this is what you get: 3 lots. Position number 1 from here to here, I believe if you timeline it, it's gonna come somewhere around this candlestick when we choose it. This one is about, by the looks of it, 20-30 pips. This one, by the looks of it, about 60-70 pips. So you're squeezing out 100 pips from this one. So let's see. Let's say you're here, 40 pips with additional 57 pips. So yes, 40 plus 60 is 100. 100 pips with 3 lots. On the first one, you would be making, what was it? Was it 40 lots? By 40 lots, sorry, not 40 lots, 40 pips traded by 2 lots. That's $800, and additional, of course, because you're not closing this position, you have additional 100 lots, which makes you another 1,000. So plus 400 plus 400, that's making you $1,800 on a brief 2-hour trade. It can't get better than that, to be honest with you. And also, even if you take any other instrument, it will get the same. Even if we scroll back in time, it will still be the same. You will still have the same instruments trading and corresponding in timeline if you combine it the right way. You can see the relative strength index 14 period and the moving averages plus Bollinger Bands. This one and this one is also 14 period with the very important 200 period moving average, which tells you, and one more time, it's an exponential moving average. All of those giving you areas where you should trade or you should not trade. Now, an area where you should not trade, such as this one, 1, 2, 3, still there is a strong directional move here. You might be able to enter it somewhere around here, okay, somewhere around here on this area. Still, I wouldn't enter over here because the price is too close to the 200. So basically, you can make that move down and then bounce up and keep going to the upside. Extremely, in so many places we've seen that. So pretty much this move from here to here is so fast that you can rarely catch it. Well, the only way for you to catch it is by using additional indicator, which will be the last one for today. This is the so-called Williams percentage range. What is the Williams percentage range? In technical analysis, this is also a momentum indicator measuring overbought and oversold levels, similar to a stochastic oscillator, similar to a relative strength index. Right now we're going to correspond it with the relative strength. The indicator is developed by Larry Williams and compares a instrument close to the high-low range over a certain period of time, usually 14 period. That's why we're going to use it 14 period again. It is used to determine market entry and exit points. Again, the Williams percentage range produces value from 0 to 100, one more time, corresponding with the relative strength. A reading over 80 usually indicates oversold, while a reading over below 20 suggests overbought conditions. So it's vice versa than the relative strength. You understand? It's extremely important to understand it. That's why let's put it into the chart. Let's see what it does. Okay, in this case, we're not altering any levels except the 14 period, as you see in front of you. This is how it looks like. The levels are reversed in this case, as you can see. The level of 20, it's actually minus 20, is to the upside, which is closer to the 0 level, and minus 80 is closer to the 100. So in this case, you can very much see how it corresponds with the relative strength index. You can see the timeline is so precise, especially when you use it with the additional tools as above here in this chart, this part of the chart. So it gives you extremely well, telling you this is an entry and a pretty good one. But majorly, what the Williams percentage range is been used for is to tell you how long the price will stay in those areas, and mainly because the Williams percentage range is very, very fast, faster than the relative strength index. Can tell you the continuation of a certain trend, especially if you use it on a smaller periods, as the period of 14, or if it's 14 days, it would give you a very good oversight on a daily, on a mid-trend, corresponding with 1 hour chart. One more time, a brilliant opportunity for you to trade this one here, for example, this one. And it's corresponding in timeline between, sorry, it's not very, extremely straight, but still you can see how well it corresponds in time, and it ends where it breaches and it sustains it. So you can pretty much follow the price. When it comes up to this level, you can close your positions. This is exactly where the price is pretty much moving on above here. So this is another certainty. If you have entered over here when the price is in extreme oversold conditions, over here, and the price is breaking off the 50 level, as we mentioned. This is our pivot point for trading in either direction, whether it's long or short. And our exit, as we mentioned one more time, it's over here. Of course, this one gives us only an oversight on a very small profit, a short profit, of course. But this one tells us we can wait for some more. So basically, your 3 lots, if you've entered, you can close 2 lots here. One more time, wait for another one. It doesn't really go in the level of 20 in extreme oversold conditions, but still gives you additional profit from here to here. This is where you're closing your 1 lot, which of course, profit is from here to here, over this one, X here. And this is only one, this is only one place that I'm showing you, randomly from the chart. Even if I just scroll like this, like crazy to the backside, it's still going to show you the same thing on the chart. Still telling you price is staying on the sidelines. Let's pick this one. Your Bollinger Bands are pretty flat. There is nowhere to go. You have a breach, you have an expansion of your Bollinger Bands, you have a confirmation, point A, you have corresponding in time somewhere around here, point A telling you it's actually a little bit more to the right, somewhere right here, but still it tells you this is a profit to be made, and you can exit right over here. Of course, you don't have to wait so much. When you see a consolidation, you know, when you see the price going like this, you can still exit somewhere here, but the profit would be the same. Corresponding with timeline, somewhere right here is, or even somewhere over here, telling you for certainty that the price has taken long enough to the downside, but still another entry can be taken when you can see these moves over here. Or this one, let's pick for an instance. You have a very beautiful expansion of the Bollinger Bands. Your entry comes here, corresponding in time of your, sorry, something happened to the mouse, corresponding with of course, the move happens a bit faster, a bit before that. You can see the long bullish, strong bullish candlestick over here, breaching the 50 level to the upside. You know, with so much effort to do so, it doesn't do it. Going into extreme oversold conditions, hitting the 200 period, where is definitely your exit, and going back to the downside, staying briefly, of course, in overbought conditions, but it's long enough for you to make the profit. If you correspond, I can't really draw like this. I should put a straight line with directly with this one. Over here on this one, you can see how and where the move is over. Pretty much at the same place. Or even over here, if you've waited for the next one, gives you brilliant timing. Timeline is the one and the same. So ladies and gentlemen, use it. This is what MetaTrader 4 is giving you. Nothing more. There is no technical custom indicator that, you know, can make you so much profits on a weekly base, especially if you're patient to see the signal, especially if you want to make the profit. But in this case, patience is a virtue. So don't make the mistake to enter prior to the signal. Wait for it to make the move, wait for it to confirm. There is nothing for you to lose there, except your own cash, which needs to be protected. Let's talk about FX risk management the next time. Right now, this is the last indicator, and we will end our webinar. So thank you very much for joining us today. One more time, don't forget to sign up this Friday for Forex risk management. However, for those that are interested in asking questions, there will be 5 to 10 minutes question and answering session. And I will deal with all the questions that came in throughout this 1 hour session. Thanks for joining in. Stay tuned for QA. Hello, ladies and gentlemen. Welcome back to our webinar today. Topic, one more time, technical indicators. Continuing the QA session, the first question today is it's more like an explanation. Very rarely we see alignments on all indicators. That is correct, yes. You see very rarely alignments on those indicators. That's exactly the purpose of it, you know, because it's filtering fake signals, and it's giving you more than 80% of certainty on those positions. Why would you want any fake signals, especially on 1 hour chart? I mean, you can see an alignment for, let's say, a position per day, which is, you know, with high percentage of certainty, which gives you an opportunity to enter with a big lot to make a really substantial profit. That's a pretty good one. However, the next question makes me, you know, think a little bit more about it. Why those particular indicators? We have many custom indicators. Well, why? Because there are people out there that cannot find the customized indicator that gives you an arrow when to enter and when to exit without giving an explanation why it makes that decision. You know, because it's still a robot. It's a program that you've written, as well as those indicators are. But thinking of it, you know, that you use more than one technical indicator to align in a timeline to give you a high percentage of certainty positions is something that I would rather use than a customized indicator from somebody that I don't know. So I am using customized indicators for myself to find pivot points, supports and resistance, but that's pretty much all of it. That's all I need, to be a successful trader, because I understand the market. And furthermore, I understand when to stay away from it, giving a room to the next one of the next questions. I'm going to skip over, however. It's quite a curious question. How do we avoid mistakes around the news? Well, that's a little bit not irrelevant to today's topic. However, I'm keen to answer that question because it's something that I usually get, once in a while. News, how to avoid it? Well, basically, take a look at the economic calendar. When you see an important event, for example, we have retail sales, all right? Retail sales, U.S. came negative, pretty good for the euro, pretty good for the gold, and so on and so on. Precious metals. Now, to avoid mistakes around the news is just as easy as the answer, which is stay away from the market when there is something with high volatility expectations. So if you are going to be a technical trader, you need to mind the news as long as it's necessary to know when to stay away from the market, because around news, traders have seen extreme market conditions. The price can break the laws of physics and invalidate all other kinds of technical patterns, indicators, or whatever. But in middle, average type of volatility to low type of volatility is quite good because the market is pricing in, and even the news are aligning with the chart. There are a lot of tricks and tips here and there that I might be able to teach you. But let's talk about it in our news trading webinar, which is coming out after the trend following. So it's not next week, but the week after. So it's the final week of this month, when we will be talking about news trading and another more advanced strategy called momentum trading, which is quite suitable for people that have limited time to spend on their charts and have other business. So that's why we made it as a webinar. Let's see if we have some more questions. Can I use it with USD JPY? Well, yes, of course. Sorry about that. Should have actually told you earlier that you can actually use that on a variety of currency pairs and commodities. Doesn't really matter what you use it. The higher the volatility of the instrument, the better, the more signals you will get. Still, the Euro USD that I've picked is merely because it's one of the most, the most traded currency pairs out there. So that's why I usually make the presentations on Euro dollar. So it's irrelevant to USD JPY. So you can use it on anything you like, regardless of that South African rands or Malaysian ringgit or Singaporean dollar. It's still the same. Another question we're getting: is it possible for you to go over this topic one more time? Okay, that's not quite possible. Sorry about that. So that gets me to read the next question, which came in pretty much not the last, but one of the last questions. Is this webinar recorded? Are you going to upload it later to YouTube? Sorry, I don't have any microphone. Okay, that's not a problem. You don't need a microphone, my dear fellow trader. The only thing you need is just a keyboard and a monitor, so you can watch the webinar itself. But you're always welcome to to say something if you wish. If you have a microphone, we can always allow you to touch other traders with your explanation and your thinking about the market. And if you have questions about whatever it is, the company or anything else. But yes, I will answer both of those questions simultaneously by telling you I cannot repeat this topic today, but I will repeat it not next month, the month after, because next month we're making more advanced strategies which are suitable for traders that will rely more on the technical chart rather than the news. This will be the first part, and the second for those that are trading the news. We will be focusing on specific commodities and currencies that are affected by the major economies in the world. This is a pretty interesting topic, actually. It's going to be a lot of a lot of words that people might not be able to understand, but questions are also welcome. Still, the webinar is recorded. It will be uploaded into our YouTube channel straight away after the presentation is ended. And of course, we have to edit it here and there, chop a few ends. You know how it works. Still, what you can find in the YouTube was the previous technical indicators webinar. It's still the same, with regards to the exception of the questions that are answered at the very end of the webinar itself. And of course, sometimes I do find better entries. So every different webinar is different by by itself. So it's good for you to have it. Well, that's it for today. Thanks for everybody asking all those questions. I don't really think we have too much time to attend to each and every one of it. But whatever questions just came in, I will kindly answer them straight after the webinar is concluded in an email. Directly to your email, you will find your answers shortly after 12:30. Thanks for joining in. Don't forget about the next webinar this Friday. Thanks a lot. Bye-bye.